Welcome to those of you online. Today, what we're going to be doing is covering the first three sections of Chapter 26. Chapter 26 being about capital budgeting. And we'll see what that is here in just a moment. So as we go to Chapter 26, if you'll have two things in front of you, if you'll have, let me share my screen here to show you. If you'll have the Chapter 26 outline. So looking like this. And if you will also have a file from Canvas, which will be the 26 example problems, looking like this. We'll go over the problems there and the solutions. So let me come back live here. All right. So as we deal here today with capital budgeting, well, it really is an extension of what we covered back in Chapter 25. In Chapter 25, we were talking about short-term decisions. So generally a year or less. But in Chapter 26, we'll talk about long-term decisions, more than a year, generally at least a few years. It's called capital budgeting because of this. Capital denotes an asset, especially a long-term asset, so life greater than a year. And we're going to budget. We're going to look at the cash outflows we must spend versus the cash inflows that we think we're going to get back. And of course, we want those cash inflows to be greater. So that way we have positive net cash inflow if we net the two. So just like in Chapter 25, we'll have a decision. In this case, it's whether to invest in some long-term project. It could be building a new building or buying a new asset, or in our case today, in the example problems we will use, it is expanding a ski lodge. Okay, so that expansion would qualify. It could be developing a new product or a new store, developing new software. Anything that takes longer than a year, we have to invest in it. So we invest money up front. We hope that more than pays us back in terms of future cash inflows. So for example, this building here. Well, I don't think Florida Southern really engaged too much in capital budgeting, but if they did, well, they had to spend, or at least donors had to spend, about $33 million for this building. And Florida Southern, of course, was hoping that the extra revenue from extra students, extra tuition that is, would more than pay for the building. And well, again, this building came about through donors, so it's a little bit of a different thought process and practicality. But certainly, I think this building did pay off, and we've had more business majors since, and generally better business majors, tell you the truth. So I think this building has really helped us increase in quality. But again, theoretically, comparing the future cash inflows with the cash outflows, we must have to invest in this building. Of course, we hope future cash inflows are greater. Net the two, you get a positive bottom line. So we'll be going through that same process today. Capital budgeting is not difficult. I don't think you'll have any problems with it. There are quite a few numbers, but that's okay. They're not difficult. Capital budgeting is very important because it is something that a business expects you to understand, at least in some fashion, no matter what your job is. And another important reason, short-term reason, is most of you are going to have managerial finance very soon. And they do cover capital budgeting in there. They'll kick it up a notch or two. So if you understand this in this chapter, you'll do fine. Managerial finance. So again, our decision here, whether to invest in a long-term project like this building. Well, we'll have 4 different ways of budgeting, 4 different capital budgeting methods or models. And basically, if future cash inflows exceed cash outflows, we'll invest. We'll say yes to the investment. So spend $33 million now. We hope in the future we get back more than $33 million in increased revenue from this building. No, that means we think the future revenue will be less than $33 million. That means don't invest. So if we invest, we have a projected positive future cash inflow, net cash inflow, I should say. If we say no, we have a projected future net cash inflow, which is negative. That's like a loss. Positive future cash inflow is like a profit. So we'll see that as we go through capital budgeting here. So it's a fairly straightforward thing. By the way, eventually on the drawing board, there is a second building, second business building, and it's going to go right over there, just the north of us, and it'll primarily be centered on graduate programs. I have an owner, of course, and the college owns the property going on back. And that old house we see out the window belongs to the college. It is currently rented by the college to Will Allen, who's, well, he used to be a communications professor. Esports now, I think. So he rents it. Well, at least until the college decides to demolish it. Yeah, part of the property we're on here was already owned by the college, but another part of it had an old house on it. And the owner of that house said that the college had first right to buy that property upon her death. And of course, the college vowed that it would. Well, she lived to be 106. So we celebrate her nice long life. But the college had to wait a while. This obviously was a prime piece of real estate here on Lake Hollingsworth. And it's very impressive when students and their families come through, as they did this weekend when we had day on campus. So yeah, it's paid back a lot of revenue. Yes. How much? We're not quite sure exactly how much extra revenue, but we know there's some. And often trying to estimate numbers like that is a difficult thing to do. Not always totally accurate. So it's 2 decision alternatives: either invest in the project, whatever it may be, or no, we don't. So now let me share my screen, and what we'll do first is go over some of the basics of capital budgeting. And then we'll do 2 models. We'll see the payback period method and the accounting rate of return method. Then next week, we'll get into the rest of the chapter. So here and sharing my screen. Going to turn the outline here. A little introduction. Well, first of all, capital budgeting. It's the process of making capital investment decisions. So again, generally long-term assets. Do we spend our money on this building, for example? Regarding the acquisition of capital assets or other investments. Acquisition means we build it or we buy it. We somehow get it, we acquire it. Well, examples again could include a new building, a new factory, new equipment. It could even include, in this case, a major website or major software or some other intangible. comma there. Well, usually this involves a large amount of cash to be expended. And management must engage in capital rationing to decide the projects in which it will invest its limited funds. Capital rationing basically means that we don't have unlimited funds. It ties into economics, which is the study of how society allocates the scarce resources. Same thing here. So we want to get as great a return for our money as possible. So we spend money today. We know we must spend money to make money, and we hope that future money we make exceeds what we're spending today by a great deal. That would be an attractive capital investment. Now, again, B, that time frame is long run. Therefore, management has control over such expenditures, which is not in the short run. So again, the longer run, the more we can change things. The short run or short term, same thing, we're stuck with what we've got, but we can change it in the future, given enough time. Now in C, again, we'll generally think in terms of cash flows, except in one model, which is the accounting rate of return method. Well, the future cash flows of the investment will use the 3 of the 4 methods we'll study. Therefore, non-cash items such as depreciation will not be included in these 3 methods. This ties in the statement of cash flows in financial accounting. You'll recall in financial accounting, you had to adjust cash flows for depreciation because depreciation is a non-cash expense. I'll show you that as we go through some examples. First of all, future cash inflows will include cash revenue from the investment, cash operating expense savings, that's like some more revenue, and the cash residual value of the equipment, or the investment rather, which could be equipment, but that means the salvage value, what we can sell it for at the end and get some cash for it. Then future cash outflows will include cash operating expenses from the investment. And the initial cost of the investment is also a future cash outflow, but we'll consider it separately. I will show you. But then we net the two to derive future net cash inflow. Again, we want that to be positive, not negative. Negative, we definitely will not invest in this investment, whatever it may be. Positive, we want it as big as possible. We want as much cash as possible in the future. As much net cash inflow as possible. Now, I was talking about a lot of things for estimates. Well, here I comment on that D. Even though our budgeting may appear to be very precise because we're given exact monetary amounts in our problems, remember the actual amounts can differ from budgeted amounts. Sure can, because the best laid plans of mice and men, as John Steinbeck would say, often don't come true. And the more years out we are trying to estimate or project, the more uncertainty we're going to have. I mean, just like before the pandemic a little over 2 years ago, would we have ever predicted what things would be like now? What the price of a gallon of gas would be? What inflation would be? Supply chain issues. So again, the further out the time frame, the more uncertainty we've got. So that's why actual amounts could sure differ from budget amounts. Again, this becomes even more uncertain as the time frame for the decision increases. Therefore, more risk is involved as the time frame extends. And a compensating control, something to help make up for that, is do what are called post audits to make sure that actual cash flows are going according to plans. So let's just take a fresh look at things and rerun the numbers. If not, corrective action can be taken, even up to abandoning the project. For example, a lot of brick and mortar retailers had to do post audits. They have had to rethink these stores they built in the past, and they were therefore capital investments. But they're just not worth it anymore because revenue's gone way down. And they never predicted how things would shift to online purchasing. So it's amazing how things change. So a lot of stores have been closed, including one that I was just reading about yesterday. The story I read said that another Kmart store closed. Guess how many Kmart stores are left? Close. 3. Yeah, according to this article. 2 in Jersey and 1 on Long Island. So they sure have led a slow death spiral. And the one, well, there used to be 2 here in Lakeland. Used to be one on the north side, one on the south side. The one on the north side closed 7, 8 years ago. One on the south side, maybe 5 years ago. And the one on the south side is where they built the Publix Greenwise Market. So Kmart abandoned its capital project. Publix invested in a new one. Publix, of course, calculated the spending on the Greenwise Market, building it, and also the other stores in that plaza. When the revenue from that would more than exceed the cash outflows, and well, we hope that's true for Publix. So that building that new store was capital investment. Also going into a new market is capital investment for Publix. The latest new market is, or all the way up to Kentucky, or will soon be, they're building there. So up the Ohio River. And of course, knocking on Kroger's back door since they're based in Cincinnati. So we'll see whether Publix ever crosses the Ohio River. Just like the Underground Railroad. Yeah, because crossing the Ohio River was a major milestone because that's legal freedom. But definitely going into a new market, yeah. Another capital investment. Yeah, so with Kmart closing, I assume the world's largest Kmart closed too. I haven't looked up the location to see if this story is accurate. But guess where the world's largest Kmart was? You'll never guess. No. Good guess. It was on the island of Guam. So a US possession. And I've been there at the world's largest Kmart, and I don't know what was so large about it. I think the warehouse space in the back, but the sales floor seemed about the same as any place else. One thing I remember, they had stacks and stacks of Spam. Guam is the world's largest per capita consumer of Spam. And there's even a special Guam Spam that Hormel makes. It's supposed to be really, really spicy. I didn't try it because I hate Spam, but there, Hawaii, a lot of Pacific Islands, people got hooked on Spam because that is what was delivered to them during World War I and after. So it kept, basically, it was canned. So you probably like Spam. Okay. Maybe you would like the special Guam Spam if you like it really spicy. Yeah, and Guam, like Hawaii, has Spam and eggs. Wow, that's actually a dish. Yeah, people eat it. Okay. You might just really like shopping at the world's largest Kmart. Seeing all the different varieties of Spam. Yeah, if they're still open. Good point. If not, I'm sure Guam really misses it. You're there on an island, you can't exactly go to the next city and shop someplace. Or what? Or an eBay. Yeah, true. It must cost a lot to ship it out to Guam. Oh. Yep. Yeah, with going to Guam, you either have to go to Tokyo and fly down. That's about a 3-hour flight from Tokyo. Huge flight too, from here to Tokyo, of course. Or you have to go through Hawaii. So that's a long flight from Hawaii. It's like 800 miles yet to Guam. Pacific is huge. So a lot more than crossing the Atlantic. Now, Annie, two of our capital budgeting methods will ignore the time, excuse me, time value of money, which takes into account things like inflation as we have now. The other two will include, they're therefore more sophisticated. I don't know if any of you have ever dealt with the time value of money and interest rate factors from a table. Probably not. Okay. You might have seen them if you've taken personal finance. I'll teach you about them, not hard. And you will definitely be using them again in managerial finance. So this class really is a good preparation for that. So any questions there so far? All right, let's get into our first method. It's pretty easy. Payback period method. Payback, that means we get our money back. So let's see what this entails. Well, this method reflects the length of time it takes to recover the initial cost of the capital outlay, so the initial investment, by dividing it by expected annual net cash inflows. And generally, the shorter the payback period, the more attractive the asset will be, the investment. Ceteris paribus. And just to review, ceteris paribus means exactly, all other things being equal. So any changes we'll be told about, assume everything else is just the same as it used to be. It's equal. And that just makes things easier to analyze by not overcomplicating things. So we've got two scenarios. When annual net cash inflows are expected to be equal and then unequal. But let's do equal first. Payback period equals the initial investment divided by expected annual net cash inflow. Let me show you here in this example next. So what is the payback period for a machine with an initial cost of $100,000 and an annual net cash inflow of $20,000? Here's all we do. We divide the initial investment of $100,000 by the annual net cash inflow of 20. We get exactly 5 years. So we get our money back in exactly 5 years. Again, shorter is better. So fewer years, better. Our money back as quickly as possible. Now, second scenario. When annual net cash inflows are expected to be unequal. We'll just have to compute this one by hand. It won't be bad, I will show you. So the payback period is when total net cash inflows until the initial investment's recovered. So in example, what is the payback period for an asset with an initial cost of $100,000 and the following net cash inflows for the first 4 years of its life? You can assume these are in order. Year 1, 20,000. Year 2, 35. Year 3, 25. Year 4, 40. So here's what I will do. Set up a little chart. Years, I'll put 0, 1, 2, 3, 4. Because we're concerned about 4 years. 0 means right now. So Then I will look at what has not yet been paid back at the beginning of the year. I will also look at the cash inflow during the year, and then what has not yet been paid back at the end of the year. So here at year 0, just starting things out, really beginning of year 1. Well, not yet been paid back, and it's not applicable. Neither is the cash inflow during the year. There is none. We're just starting out. So right now we pay that initial investment of $100,000. Well, let's bring that down. End of year 0, same thing as beginning of year 1. Is just like a real account, financial accounting. The ending balance of 1 year carries over to be the beginning balance of the next year. So year 1, not yet been paid back yet, $100,000. Cash inflow during the year is 20. Let's subtract that. Not yet paid back at the end of the year, 80,000. So again, ending balance of year 1 carries over to beginning balance of year 2, 80,000. Cash inflow during year 2 is 35. Subtract that, we get 45,000 not yet paid back at the end of year 2. Again, that carries over, beginning balance of year 3. Cash inflow during year 3 is 25. Not yet paid back, the end of year 3 is 20. That carries to the beginning of year 4. Cash inflow during year 4 is 40. Oh, we're over at the end of year 4. So we have to backtrack. We're not going to go quite to the end of year 4. Let's compute a partial year. Well, the 20,000 not yet paid back divided by cash inflows in year 4. That means about halfway into the year, we get paid back in full. So we've gone year 3 plus half a year in year 4. So 3.5 years is the payback period. Any questions so far? Okay. Well, indeed, some advantages of the payback method are the simple compute and it focuses on the time it takes to recover the company's initial investment. But any disadvantages are that focuses only on how much time it takes to recover the cash and therefore ignores the accrual accounting profitability. Also ignores cash flows that occur after the payback period, including any residual value after that time. So any residual value, once the asset's exhausted, we sell it and get something back. Salvage value, same thing. Also ignores time value of money. But then F, since payback period method is quite simple, managers usually use it as a screening method. And if an investment appears to be desirable, then it's usually subjected to a more sophisticated screening method to decide whether to invest in it or not. So managers will use one of the following 4 methods, one of the 3 remaining methods, I should say, maybe all 3. Any questions there about the payback period? Okay. Well, let's go to the one method that considers not cash flows directly, but financial accounting income. And that's the accounting rate of return method. All these acronyms in business, it's usually abbreviated as ARR, and in fact will be in your finance textbook. Or this book abbreviates it ROR, which is kind of unique. I guess they just wanted us to learn a new acronym. But we see this method measures the mean rate of return on the investment using accrual accounting operating income. So financial accountants like it. And in ARR equals the mean operating income from the investment divided by the mean amount invested. I'll show you how I compute those. But like any rate of return, we want it to be as high as possible. So more than one asset, we tend to go for the asset with a higher accounting rate of return. or one possible investment is. Well, for that mean operating income, we first have to calculate the total operating income from the investment equals total net cash inflows during the operating life of the investment minus depreciation and other non-cash expenses related to the investment during its operating life. Depreciation is the only one we've actually seen so far. We saw it in the statement of cash flows. So you may recall the statement of cash flows that to adjust from accrual accounting income to cash flows, we add back depreciation. This time you're just subtracting it, get rid of its effect. If you don't quite remember that from the statement of cash flows, just trust me. Now, if we want mean annual operating income, we take the total operating income from the investment and divide by the investment's operating life in years. And the mean amount invested in the investment is derived by adding its net book values at the beginning and end of its operating life and then dividing by 2. By the way, book value, you probably recall from financial accounting, means original cost minus accumulated depreciation. So we'll take the initial cost of the investment, add any residual value that there may be at the end of that investments or assets useful life, we'll divide by 2. That's all. So I'd like to show you some numbers there. I will come back to F, G, H, and I after I do. Or actually let me skip down to I should say. We're going to look at examples 26.4 through 26.6 on page, starting on page 1465. I've reproduced these short exercises for you, the S standing for short. And where I reproduce these for you as we go through them is on that additional handout I've got on Canvas for you. Chapter 26, example problems, it's PDF. Let's start off with number 4. Now, in this series of problems, they first take us through a lot of rigmarole in calculating cash flows, and I won't have a problem like that any further. So certainly nothing on the exam. So if you get through this, you're more than good. But they complicated this, I would say, needlessly by doing it, but don't worry, we'll follow it through. So using the payback and accounting rate of return methods to make capital investment decisions. So here's a really good example of a capital investment decision. You can see that. If you have any trouble seeing anything, just let me know. So we're considering how Hunter Valley Snow Park Lodge could use capital budget to decide whether the $11 million Snow Park Lodge expansion would be a good investment. So they're thinking about expanding the ski lodge. Well, it's going to cost $11 million to do so. So will future revenue be greater than 11 million, basically? If it is, great, a positive bottom line, just like profits. But again, the higher that bottom line is, the better. So we're to assume the Hunter Valley's managers develop the following estimates concerning the expansion. So we're going to look at the number of additional skiers per day that this expansion gives us, 120. We'll look at the average number of days per year that weather conditions allow skiing in Hunter Valley, 142 days. So you can bet we're going to multiply those, calculate volume. Let's work our way to revenue. Well, the useful life of the expansion, we're to consider 7 years. Hopefully it's more than that, but they're only going to look at 7 years. The average cash spent per skier per day, $241. So you can bet number of skiers times number of days times average cash, there's annual revenue. Then the average variable cost of serving each skier per day, $83. So each skier is profitable. Cost of expansion again is 11 million. Discount rate 10%. Don't worry about that until we get the time value. Then we are to assume the Hunter Valley uses straight line depreciation method, expects the lodge expansion, excuse me, to have a residual value of $600,000 at the end of its 7-year life. So somebody will take it off our hands, we think, for $600,000. Of course, 7 years ago, if we tried to predict the price of property like this, we would have underpriced it, I'm sure. Now, property, who knew that the value would go up so much? Here in Lakeland, 25%. Last year, it's amazing. Some areas of the country even exceed 30%. So we're to compute two things. We won't compute ARR until the next short exercise, but two things to help set it up. We'll first compute the average annual net cash inflow from the expansion, just like revenue. And then we'll compute the average annual operating income from the expansion. All right, let me do that. I'm going to flip down a few pages where I have solutions. Here it is, short exercise number 4. All right, first thing they'll compute, the average annual net cash inflow. So got to take the average cash spent per skier per day, just like I pointed out, multiply by the additional skiers per day, and multiply by the average days of skiing per year. So that gives us $4,140,862. That's the cash we predict will come in. Total cash inflow or revenue. Then, to make money, we have to spend money. So the average annual cash outflow. Well, what will change with each skier per day is we will incur $83 more, the variable cost. So let's take that 83. Multiply by the additional skiers per day of 121. And once again, the average number of days of skiing per year, 142. That gives us a cash outflow for the year we predict of $1,426,106. Then the average annual net cash inflow. Well, we take the total cash inflow, that $4.1 million figure, we subtract the cash outflow, what we just computed, 1.4 million and change, and we get a net cash inflow, difference between the two, that is, of $2,714,756. All right. Now, requirement 2, where we're to compute the average annual operating income from the expansion. Well, first, we're going to take the total net cash inflows during the operating life of the expansion. Let's take that $2.7 million annual figure, and we'll multiply by the 7 years of operating life. That's going to give us a grand total over those 7 years of $19,003,292. Now, those are the total cash inflows. We want to get back to accrual accounting income. So since those cash inflows did not include depreciation, let's subtract it off now. Well, the total depreciation during the operating life of the expansion will be the initial cost of 11 million minus the residual value of 600,000, giving us 10.4 million. Now, finally, Let's take those total net cash inflows of 19 million, subtract off the depreciation of 10.4 million. That brings us down to total operating income during the operating life, $8,603,292. And to get an average per year, we divide by 7 years, giving us average annual operating income for the expansion of $1,229,042. Now, don't worry on anything else. Those totals are going to be given to you. That they just took us through a lot of calculations here. Probably not necessary calculations, but they wanted to show us everything from the get-go, I guess. Any questions there so far? Right? Let's come back and take a look at problem number 5. Back up here to the first page. And over here on the right-hand side, we want to review the payback method with us. So we're to refer to the same expansion project, calculate the payback for the expansion project, round to 1 decimal place. All right, let's come back down to the solution. If you need me to write anything on the board to further explain it, just let me know. There are the lights. At least the air conditioning is working okay. Yeah. So the payment. The amount invested. So the amount invested, again, 11 million, we'll divide by the expected annual net cash inflow. It's equal per year. So we can just divide, as we did in the first iteration of the payback period method we had earlier. Is $2,714,756. We computed that just a bit ago. And that will give us a payback of 4.1 years, so close to the year. Any questions on that? Right. Then finally, problem 6. Up here. Using the accounting rate of return method to make capital investment decisions. So again, refer to the same expansion. We'll calculate the accounting rate of return, round to 2 decimal places. All right, those are the marching orders we're given. Let's come down to the solution here once again. So for accounting rate of return, one thing we're going to, or just looking at the formula right here, just to remind ourselves, equals average annual operating income divided by the average amount invested. So we need to get the average amount invested. We're not given that. So that would be the initial cost of 11 million, the initial investment that is, plus, whoa, let there be light. Beam back on. And we didn't even move. Plus a residual value of 600,000. We'll divide by 2. When we do, we get $5.8 million. Now, finally, the accounting rate of return. We already knew that average annual operating income because we calculated it. $1,279,042. We divide by 5.8 million. Again, accounting rate of return of 21.19%. Good rate of return. So again, higher is better. We want the highest accounting rate of return possible. So if management wanted, let's say a 10% return, whoa, they more than exceeded that by twice. Good. I guess scheme must be profitable. No. So where I'm from in the Midwest, well, it's pretty darn flat. So there are some artificial hills actually they built over the years for skiers. Okay, that doesn't sound as good as going to a real mountain and skiing down. Yeah, and artificial snow too, because unless you're on one of the Great Lakes, generally in the Midwest, there's not a whole lot of snow. I mean, there can be, but mostly it's just cold, icy at times. Any questions there about counting rate of return? All right. Let's come back here to the notes. Three things I need to go over: F, G, and H. Well, first in F, companies which use accounting rate of return will set a minimum accounting rate of return for capital investments, just like that 10% figure that management wanted that I just assumed and told you about. They will reject capital investments with accounting rates of return less than this percentage. Of course, they want the project with the highest possible accounting rate of return. Higher is better. While G, an advantage of accounting rate of return is that it considers accrual accounting income figures over the entire operating life of the asset, unlike the payback period method. Therefore, it shows how the investment will affect accrual accounting operating income. And that's important financial statement users. And H, a disadvantage of accounting rate of return is that it ignores the time value of money. Or, like the payback period method, it's an initial screen for the investment. Looks good, then we'll go on to a more sophisticated method. One of the two we'll study next week. Gone through those examples. So that's what I wanted to cover today. We're in great shape as the end of the semester approaches. Can't believe it's coming up so fast. We have no time crunch here in this class. Good news. So some other classes having time crunches. Okay. Yeah. Yeah. Marianne, sounds like you have a definite time crunch in class. Not fun, is it? Okay. Not too bad. Good. Wow. So, no questions or anything? Well, remember, tomorrow's Good Friday, so there's no class. And, excuse me. So, happy Good Friday, happy Easter. And I'll see you back then, the Tuesday after Easter. So, it's also Passover, which always coincides with Easter. It has to do with New Year. So, I forget the exact rule. Yeah, Easter's first Sunday after New Year. That's it. Yeah, the Jewish calendar is ruled by the moon. And it's a very accurate calendar, actually. But yeah, so it's Passover, basic. So I've got 2 dinners to go to. Do you know the name of the dinner for Easter? For Easter. For Passover? A Seder. And that's where communion came from. So the Last Supper, that was actually a Seder. It was occurring at Passover. So at this time. So it's interesting to know where things in religion come from. And as I'm sure you discover in your religion class, there's always a reason. And most things in Christianity tie back to Judaism, because that's the mother religion, so to speak. So, or are they really 2 separate religions? It's a topic for discussion. Yes. All right. So enjoy, relax, and I'll see you next week. Bye-bye.